Hey, welcome back in now. Well, if you're looking for a guaranteed income stream during retirement, someone might suggest an annuity, but is that a smart choice for you? If so, what are the pros and cons? Stewart Welch from the Welch Group joins us now to give you some insight on that. Stewart, good morning.
Good morning, Mike.
Well, let's first of all explain what an annuity is, and then we'll get into a little bit why it would be advantageous for some and maybe disadvantageous for others.
Well, I think, first of all, an annuity is an insurance product, so it's a contract between you and an insurance company. And ultimately, if you annuitize, what you're doing is you're giving them a block of income for a guaranteed stream of income, typically for life. And so I think when the stock market, the first thing is annuities are a cautionary tale. So I think people that are considering an annuity ought to be like caution, red caution flag. The first thing is, Mike, they tend to have a lot of expenses associated with them, both upfront and ongoing. So the ongoing expenses can be, 2 to 3% a year, and that makes it pretty hard for them to be a good deal over 10, 20 years. They also, if it's a fixed annuity, they're based on current interest rates, which are very low, so they make them really not a good deal at this particular time. And it's a contract between you and an insurance company, and so you're really counting on that insurance company to be there 30 years from now. And that, of course, might make some people a little bit nervous. But there are some good things, and I think particularly when you retire, think of Social Security as an annuity. It's a guaranteed income for life. And you take a look at what your Social Security income is and how much basic expenses are covered. And if there's a block of expenses that you want to be guaranteed covered, you could do something called an immediate annuity. It's where you take money at retirement, give it to the insurance company, and they immediately start giving you an income for life. And those tend to be very low commission. So I think the cautionary tale is, if you're thinking about an annuity, be sure to get a second opinion and take a look at no load or low load annuities compared to what I would call a full load annuity.
Now, is this something that you would only get from an insurance company, or let's say you were to use, say, a mutual fund company, like, say, particularly one out of like Valley Forge, Pennsylvania?
Yeah, they're all going to be through insurance companies.
Okay.
You can think of it like I can go to a Vanguard or a Fidelity and buy it, and you think of them as mutual fund companies, but they're using an underlying insurance company to fund that particular product.
Wow. All right, and finally, you mentioned no load. If you were to reach out to a fiduciary, is this something that they would suggest normally? Because obviously they're a person who's a financial planner who is actually looking out for your best interest, not really to make a commission.
Yeah, I think that when you move out of the commission world into the fee-only world, the annuities are going to be recommended at a very low rate. So you don't see a lot of recommendations there. I look at friends of mine across the country that are in this business. They very rarely would recommend an annuity. There's so many other better options.
All right. Some very good information there from Stewart Welch and Welch Group. Appreciate that. Very helpful. Thank you.
Thank you, Mike.